Chapter 13 is about the effects of retained earnings on the income statement. We have several learning objectives. We're going to account for stock dividends, account for stock splits, account for treasury stock, report restrictions on retained earnings, complete a corporate income statement including retained earnings per share. The first learning objective is to account for stock dividends. A stock dividend is a distribution of a corporation's own stock to its shareholders. Unlike cash dividends, stock dividends do not give any assets to the shareholders. Stock dividends affect only shareholders' equity, including retained earnings and common stock. They have no effect on total stockholders' equity, and they have no effect on assets or liabilities. A stock dividend decreases retained earnings and increases paid-in capital, as it is a transfer from retained earnings to paid-in capital, specifically to common stock and paid-in capital in excess of par common stock. Total stockholders' equity is unchanged by a stockholder's dividend. The corporation distributes stock dividends to stockholders in proportion to the number of shares the stockholder already owns. Suppose you own 1,000 shares of a company common stock. If it distributes a 10% stock dividend, you would receive 100 additional shares. You would now own 1,100 shares of stock. All other stockholders also receive additional shares equal to 10% of their stock holdings, so you are all in the same relative position after the stock. A company issues stock dividends for several reasons. To continue dividends, but to conserve cash. A company may wish to continue the distribution of dividends to keep stockholders happy, but may need to keep its cash for operations. A stock dividend is a way to do so without using corporate cash. The second reason is to reduce the market price per share of its stock. Depending on its size, a stock dividend may cause a company's market price per share to fall because of the increased supply of stock. And the third reason, to reward investors. Investors often feel like they have received something of value when they get a stock dividend. As with a cash dividend, there are 3 dates for a stock dividend. The first one is the declaration date. The second one is the record date, and the third one is the distribution date, or the payment. The declaration of a stock dividend does not create a liability because the corporation is not obligated to pay assets. With a stock dividend, the corporation has declared its intention to distribute its stock. The entry to record a stock dividend depends on the size of that dividend. Generally accepted accounting principles distinguish between a small stock dividend, less than 20% to 25% of the issued shares, and a large stock dividend, 25% or more of issued stock. Stock dividends between 20% and 25% are rare. Small stock dividends are accounted for at their market value. Here's how the various accounts are affected. Retained earnings is debited for the market value of the dividend shares. Common stock is credited for the stock's par value. Paid-in capital in excess of par common is credited for the remainder. Large stock dividends are rare, but when they are declared, they are accounted for at par value instead of market value. Par value is used because the larger number of the shares will reduce the market value, making it an invalid measurement of the dividend value. Distribution is greater than 20% to 25% of issued shares. You debit retained earnings for par or stated value of the shares, and you credit common stock for par or stated value of the shares. Here is the stockholders' equity after stock dividends. Note that with a 5% common stock dividends, Total stockholders' equity stays at $30,105,000. Total paid-in capital increased $5 million, and retained earnings decreased $5 million. Notice that the large stock dividend also does not change stockholders' equity of $3,105,000. However, total paid-in capital increased $1,050,000, and retained earnings decreased $1,050,000. Here's a short exercise, 13-2, which compares and contrasts cash and stock dividends. In the space provided, insert either cash dividends, stock dividends, or both cash dividends and stock dividends to complete each of the following statements. A. Both cash dividends and stock dividends decrease retained earnings. And B. Stock dividends have no effect on a liability. C. Stock dividends increase paid-in capital by the same amount that they decrease retained earnings. And D. Cash dividends decrease both assets and total stockholders' equity, resulting in a decrease in the size of the company. Exercise 13-3 involves accounting for a stock dividend. This is the Yummy Inc. Has 310,000 shares of $1 par common stock issued and outstanding as of December 1st, 2012. The company is authorized to issue 1,400,000 common shares. On December 15th, 2012, Yummy declared and distributed a 5% stock dividend when the market value for Yummy common stock was $3 per share. The requirements are to journalize the stock dividend and how many shares of common stock are outstanding after the dividend. Journalizing the stock dividend, retained earnings would be a debit for $46,500. Common stock is a credit, $15,500, and paid-in capital in excess of par or common is $31,000. How many shares of stock are outstanding after the dividend? You take 310,000 shares plus 15,500, and that is 325,500.